Okay, Bus Bench Babes, spring market is here. And I have one of our favorite professionals back to talk about all the things happening in the mortgage business. And I'm peppering her with all the questions that I know you want to know as well. So let's dive into a conversation with the awesome Ellie Cummings.
You're listening to the Girl Get Your Face Off a Bus Bench podcast, where we invite you to check your ego at the app, grab a cup of coffee, and get ready to dive into all things real estate marketing, social media, friendship, hardship, love, money mindset, and all the things that celebrate you as a badass boss babe.
We're here to encourage you, show up for you, give you a loving kick in the pants when you need it most, and be your soft place to land on the hardest of days. So pull up a seat at our table and get ready to be inspired and start living your best life by design.
Welcome to the Girl Get Your Face Off a Bus Bench podcast. We are so excited you're here.
Okay, girls, let's dive in. Hey, Bus Bench Babes. I have a really special treat for you. I have Ellie Cummings back on the show. She's a three-timer. She is one of the executive VPs at New American Funding. She's an absolute boss babe, and she's so brilliant in her industry. And I've known her for years, and we've had her on twice before. So if you love this episode, go back to episode 80 or 127 for more goodness. But welcome to the show, Ellie. I'm so glad you're back.
Thank you. I'm super excited to be here.
Yay. Well, tell us a little bit about yourself and about like your role within the mortgage industry.
So my role now is it's very different than it was when I first got into it. So a little trip down memory lane. I got into it 27 years ago. And I have to always say this out loud because I'm not old enough to be in this 27 years.
You're not. You're 35.
So it's crazy. It was like the Doogie Howser of mortgage. I got in as a small child. So I've done most everything in the mortgage space. We all start somewhere, and I have spent most of my career now on the leadership side and the sales side, but I've done literally everything you could think of inside the industry. And I don't know if I'm crazy or what it is, but I absolutely love it. And it's probably sounds stupid to a lot of people, but I'm excited to get up and go to work every day and figure out how to find solutions and work in this crazy world we call mortgage.
Well, and you must. I mean, otherwise you wouldn't be in it for 27 years. Like, it really seems like it's your passion. And then when you and I have mortgage conversations, it's like, yeah, like you know this like the back of your hand. You're such an expert. And I would say like, you probably wouldn't be that much of an expert if you didn't love it as much as you do.
Well, I'm glad to be called on or looked at as an expert. Like I said, it's what I love. It feels like second nature, and it's every day I'm excited to figure out what can we do next in this world of mortgages.
I love it. Well, you sort of answered my second question where I was like, what excites you about it? We talked about that a little bit already. So how do you stay informed? Like trends, changes, like this is a moving target, it feels like. How are you, the professional, staying on top of everything?
And it is a moving target every single day. So I geek out over information and data. And every day I start my day with Bloomberg, reading all the financial news, what's going on in the MBS market. I follow the MBS Live dashboards like a little bit of a crazy person, but I find it very interesting. And even NAR and the Mortgage Bankers Association, there's so much data, but it seems like, at least to me, you have to be looking at that every day because so much is changing. And there are so many things where it's like what we used to use for predictions that we're always like, oh, this is a really good gauge, just isn't anymore. And we've been like post-pandemic living in a world of anomalies, for lack of a better term, when it comes to so many things. So it's like looking at that, looking for new trends and paying attention to what the needle movers could be, I think is super important.
That's awesome. What do you think are some of the most significant factors shaping the housing market now that as we're a month into 2025?
2025, it's like holy cats. we're continued to, so there's, I think, things that shape it that are still some challenges, but it's like some sticker shock is worn off. And when I say that, I'm talking about rates. Like we're in a market where we've had some limited inventory, but I think inventory will be tight. But when we talk about like what will shape the market this year, it's everybody knows what we're dealing with. The fact that we've had higher rates for a while I know this is an unpopular opinion, but it's actually been a good thing when it comes to helping replenish some inventory, because we're giving it a little bit of time to actually have some housing supply. I mean, we're still very short, but the fact that we sit where we do right now, and if we hang out here a little bit longer, I think that will set us up for some more longer term success, because we need to keep seeing home builders buy, like to reshape the industry, to actually like see some things. We need to have some time to catch up. And we've had the opportunity for some of that coming off of like the highest rates that we've seen in years.
Mm-hmm. How do you see the housing demand evolve this year, especially for like those first time home buyers, like the Gen Zs and the millennial folks?
It's going to be high. Like I was reading something a couple weeks ago, and the millennials is going to be a little bit lower, but still over 50%. But it's a little lower because, I hate to say it, like that's a population that's almost aging up. Like a lot of them have already become first-time home buyers because they're not the 20-year-olds anymore. Like when we look at the demographic. And so then when we go to the Gen Z, you're looking at 60 to 70% this year, they predict, of Gen Zers that want to buy a home, that are actually in the market to buy a home. So awesome. Of the people buying, I do think those are the two largest demographics that we're going to see this year.
I love that. What trends are you seeing in like home inventory levels? Like, do you think we're going to get more relief in the housing inventory?
Oh my God. Let's hope. And it's so pocketed by market. Like there are some markets that we see, especially up north and in greater Minnesota and Minneapolis, where you see it happening faster than you see like those Sunbelt states where the demand is higher on that. I do think it's going to continue to be tight, but still quite a bit more. I mean, as an industry, if we look at inventory, there has to be more, because every genius economist out there has a range of even like mortgage applications from 10 to 15% up this year over last. And I'm not talking in refinances, because that's kind of not the highest factor.
Yeah.
And it is the only way that happens is because we can replenish some inventory to have homes available for people to buy. That's
really encouraging stat to hear, though, that mortgage applications, they're anticipating them to be up 10% this year.
10 to 15%. And so you can look between the MBA and Fannie and Freddie, and the MBA traditionally is a little more conservative, and they're in the double digits.
And that's like the Mortgage Banking
Banking Association.
Yeah. Okay. Just for someone that's not in the biz.
Yes.
What are your predictions for affordability for first-time home buyers? Do you see any relief coming in 2025 for that group of people?
That is tough. And there are some things, though, that will help move the needle. And there's some that are already out there that just aren't as widely adopted, but we're seeing a lot more education and visibility around it coming into this year. So there are some programs when it comes, because I'll just back up, like affordability is a challenge. If we're looking at when we go to historic lows of interest rates, and we were seeing people get 3.5% without batting an eye, and now they have to qualify at 7%. I mean, that's double. It's not double the payment because of principal, but that is a significant increase in a payment. Yeah. And at the same time, home prices have gone up every single year since that. So there's no doubt a challenge there. But what's happened over the last year and continues to happen is the agencies, like when I say agencies, Fannie Mae and Freddie Mac, have continued to actually come out with programs that they're opening up into more markets that are designed to increase affordability for people that are in the mid to moderate income, not just low income ranges, because it affects all walks. Yeah. And there's programs available that cap like loan level price adjustments, and what that really means to someone who's not in the mortgage business. It it keeps the interest rate lower because there's less risk adjusters that are factored into that because they're subsidizing them to help with affordability. There are reductions in mortgage insurance for that. There are some programs in certain markets that don't even have mortgage insurance with that, and they continue to focus on that to help in that affordability aspect. It doesn't help everyone, and it still is, limited, but it's right out of the gates. It is helping a really big demographic that needs it. We just need more people in the industry talking about it and learning about it and being aware of it, because it is newer and it's really easy for people to just do what they know and look at the programs they know and not find those all of the time. And
yeah. And from a consumer standpoint, they're like, well, houses keep on getting more expensive and interest rates aren't coming down. So then it's not affordable. But like you're saying, there's other factors behind the scenes that you don't even know about that are creating affordability that you're not even tapping into.
Right. And that's where like the word that we're always trying to get out is talk to a professional. Because it's like we're so used to, we have between social media and the internet, we have information overload at our fingertips. But a lot of times it's uninterpreted information. And when we're just looking at it and it's not in our lane and not in our space, we don't know what it really means. And if you don't know how to search for it, you're not going to find that Fannie Mae has programs that are designed to reinvest in communities and help give price incentives when it comes to interest rates to certain demographics of borrowers. It's also like finding a needle in a haystack on your own to find certain types of down payment assistance that exist out there.
So many. It's overwhelming.
There's a lot. It is. And that's where it's like you need a professional to work with on that, because even we'll go to Minnesota, in the 7-county metro, there's hundreds of them, and they can be very specific to, some of them are literally just to a certain city. Some of them are within a certain block range of that city. Some of them are countywide. And every year they change because it's all like reinvestment into the community money, and it's like bonded money that they have so much to use. But that's something else that you can't really find just by trying to Google it.
Yeah, no, you absolutely can't. And I feel like, even I've been doing real estate as long as you've been doing mortgages, and it's still, there's so much info to know on this. And that's why I'm like, I need to connect you with a professional, because and everybody's scenario is going to be so different with that.
For sure. It is like, and what continues to be true over and over and over again is lending is not one size fits all. And it is not push button, get mortgage. And if we were in a world where that was what it was, we would limit so many people from being able to own a home.
Yeah. Well, thankfully it's not. Thankfully there are options.
Right.
Well, the burning question of the hour, what do you think rates are going to do in 2025?
Oh, I would love to say, I think we're going to see 5s, but no, I think that, so I'm going to talk like in unadjusted rates, because this is just like just for everybody out there to hear. You'll see a rate that's put out by like Fannie Mae or an economist for where they think mortgage rates are. And that is what we call an unadjusted rate, because it's a very generic rate that doesn't factor in credit score, down payment, all of the other things that could affect an interest rate. So right now we have that unadjusted rate is around 6.8, 6.9, like it was above 7% last week. If you looked at a mortgage forecast a year ago, you would have seen a 5 at the end of this year. And with how sticky inflation has been and just what the data has been coming in at, everything has been revised. And we're probably looking at rates in the mid 6s by the end of the year, not even really low, like 6.5. But 6.5, if you think about it, in that range, let's just say 6.5 to 7, because that's where you're going to land. If the unadjusted rate is 6.5, you're going to see a range between that and 7%. And we're not talking paying points or buying it down. We're just kind of giving that generic. That is a reasonable rate when you think about the fact that you're borrowing money for 30 years. It's a tougher pill to swallow because we saw such low rates. We saw historic lows that weren't sustainable. So 6.5 is still a rate that can give us a very robust housing market. So these predictions, and when we look at housing and looking at mortgage like applications and activity being up 15% from last year, that's with rates being in the high sixes. So there is a market where that works. And for most of my career, if we took out the crazy times, rates in the sixes were amazing. They were in the eights when I got in, and we went through a big refi boom because they went down to 6.875. And I can remember this was when we had to handwrite good face, like doing them like crazy. And I'm like, oh my God, 6.875. But then we were back up to like 8.25 and nobody batted an eye.
Yeah.
But I mean, the pricing of houses was different and a lot of things were different, but 6.5 is a sustainable rate. It's just everybody has to adjust their thinking and go into like looking at things of your mortgage interest rate doesn't need to be your cocktail conversation point or a vanity number that you have in your head. It should be a number that works for you. And if 7 works for you, great. If you want to buy an investment property and it's 8% and it cash flows, great. Worry about the other things, not the actual number.
Yeah, there's a lot of hyper focusing on that number.
Yep.
How do you think the Fed's policies will influence mortgage rates?
Do you hear that? So we have someone with very loud opinion on that right now. Really. So
my cat's meowing, your dogs are barking. like wild jungle.
So the Fed policy this year, like a little color on this, is there's always what the Fed indicates and what their dot plots show. And then there's the speculation of what people think. So like last year, the Fed never came out and said, we're going to cut interest rates by 200 basis points, or the equivalent of 2% on the Fed funds rate. But a lot of bond traders took it upon themselves that they thought all this economic data was going to lead to that. And the Fed was pretty steady in saying, we probably won't cut until the middle of the summer and maybe a quarter point. We'll cut again for a quarter point. And they did ultimately 3 quarters. The market was pricing in up to 200 basis points. So 2 points that they're not going to do. They've come out and said, like they keep saying, we're gonna watch it. We're gonna measure the data, and we'll see if cuts are here, and maybe another quarter to a half. So now we're seeing the market like kind of readjust, where they're like, well, maybe that bet that we took was a little too aggressive. So the fact that the Fed is saying, we don't really know if we're going to keep cutting, we're kind of on the fence, that the market is really in line with that. So long story longer, the Fed has not changed their stance or their policy at all. They are like a one-trick pony when it comes to inflation and how they're going after the rates. We have the traders that really affect the market in general of the rates that you pay for a mortgage, because you don't pay the overnight Fed funds rate, you pay what the market's trading at. It's been more manipulated, and we're going to see a little bit, I think, less of that. Now, I will factor in one thing about that. So Fed policy right now, that's what's keeping us so flat. They're not really changing. We keep seeing, I don't know, I still see crazy prices at the grocery store, but then you read an article that like inflation's finally under control, and it's like, where? Show.
I thought the exact same thing when they were talking about that. I'm like, nothing has come down in price. My Starbucks is still $2 higher than it was a couple years ago.
Yeah. And it's never going to go back down. The cheeseburger at McDonald's is never going to be $1 again. We don't go backwards on that. So it's like we can slow the inflation, but we don't reverse where we sit. And
unfortunately,
no. And that's the hard part. So we're in this battle of wills, I think, with the Fed, who looks at very limiting data when it comes to how they're measuring that and if they should cut rates. But we're stuck with the same policymakers for another 15 months, give or take, because Powell's in until May of 2026. So there's a lot that the wild card is there's things that could be affected by the new administration, but there's things that just aren't, because a president can't oust a Fed chair. So not until his term's up. So we're going to see a lot of the same. Now, the real wild card in all of this, though, and if there was really going to be a splash that wouldn't be the most unheard of thing in the world, is the new administration could say that they want to start buying mortgage-backed securities again. So that's one of the things that's been holding rates where they are, is when we went away from that quantitative easing from the pandemic and we started tightening things again and raising rates, the Fed stopped buying mortgage bonds. And during that time when rates were as low as they were at historic lows, the only buyers of those were the government. Because think about it from a practical standpoint. If you're going to tie up your own personal money for 30 years, do you want to lock yourself in at a rate of return of 2.5%?
No, that doesn't even make sense.
So the second the government stops buying them, the natural thing that happens is rates go up, because in a fair market, investors want a fair rate of return on their money. So our wild card right now, that could be the one thing that could change rates, is if the administration comes in strong arms and figures out a way that says we're going to designate to start buying mortgage-backed securities.
But rates aren't going to be back down in the 4% ever.
I mean, I don't think I'll see that in my lifetime. It's just barring something
horrific.
Yeah. And we would be talking like an act of God, war, something horrible for something like that to happen.
Yeah. Well, hopefully, knock on wood, we don't have that anytime soon.
Exactly. But maybe the fives. I mean, we'd be happy with some high fives.
I know. I think any number that has a 5 in it, in my mind, feels super magical at this point.
For sure.
Yeah. Like you as lenders, or like lenders in general, have you seen like tightening or loosening of anything like in credit standards, or do you anticipate any of that changing this year?
I see more loosening in credit standards, and loosening with good guardrails, but has definitely been loosening, and there's a lot more product coming to market that we in the industry, we call it non-QM, which is, I hate the term because QM stands for qualified mortgage. So we're basically saying a not qualified mortgage, but that's an acronym that came from a regulation around saying that any loan essentially that's not Fannie or Freddie or FHA is considered not qualified. So it is more private capital is really what it is, because it's lenders creating product that the market needs that fall outside of those boxes. And that is a space right now where we see a lot of growth. And there's a lot of growth in that space in the like bank statement programs for self-employed people that just don't qualify under traditional agency guidelines for foreign nationals in parts of the US. And it's not just in the southern US, it's all over. Some of the largest real estate investors are foreign nationals buying real estate in the US. And those programs fall outside of a traditional Fannie or Freddie program. And there's a ton of growth on that side of it. And even for ITIN borrowers that fall outside of that, and those are people that are here under about 100 different types of ways to get here and visas and whatnot that qualify to be here, but don't qualify to purchase under traditional means, that there are options for them as well.
That's really cool.
Yeah. There is a lot out there. It just is. We added like 900 products last year. It was one of the biggest years of adding product iterations. And I feel like every week we see more product in general and just more tweaks to guidelines that make things easier to work with for people.
Is that just at your mortgage company, or are you seeing that throughout the industry?
It is throughout the industry, and in the larger companies you see are doing a really good job at it. And I don't want to say the smaller ones aren't. Sometimes it just depends on your capacity and your ability and the time you have to bring on product, because it is it's a full-time job for a crew of people, not just one person to vet that out and look and find the product. And
it sounds like a lot.
For sure.
Are you guys seeing any particular challenges in the mortgage business right now that maybe you weren't seeing the last couple of years?
It is nothing out of the ordinary. I mean, I think just the general consensus is around affordability. I mean, there are certain scenarios where you're like, well, I know the house you fell in love with is $400,000, but you can't go a penny above 350,000. I mean, those are the hard parts of the conversations. I feel like we have more opportunity now than we have had in the last couple of years, because whenever you see a dramatic shift in the market, like when rates went up so fast, like we joke, it's like rates go up like a rocket and down like a feather. And when it happens, you see those shifts. And whenever anything crazy is going on, people contract. Like lenders that are making the loans get a little nervous. People sit back and they want to see what's going to happen in the market. You have warehouse banks that say, we don't want to allow our partners to fund certain types of loans. So you saw contracting that came out of fear. And then you get through that. And so now we're in we're not in uncharted waters anymore. We're 3 years into this market that is post low rate pandemic market. And I think that we're to a point of more opportunity than challenge.
That's awesome. That's really good news.
Yeah.
How is technology playing a role in the mortgage business? Are you seeing anything new in tech?
That is always at like the top of the list of our conversations. And we're always looking at tech stacks, we call them. And I would say the same with my peers in the industry. And how can we create efficiency and whatnot? And there are certain areas where we see it advance, but I'll go back to, I made that comment about it's not as easy as push button, get mortgage. And if we did that, so many people wouldn't qualify. We are with the demographic of homebuyers. And when you think of millennials and the Gen Z and the immigrant population, which is going to make up the majority of home buyers over the next 10 years, there's a lot of non-traditional views around credit. And when I say non-traditional, it's not that they don't have credit or understand it. They have just lived in a different generation of how things were looked at. So on paper, it's not as simple as letting like AI take over, because it's like you have to explain the scenarios. You have to you have so many people in like the gig economies and influencers and self-employed and different things. And that stuff needs critical thinking and massaging, and it can't just go into the black box of a computer. So there's technology that can create certain lifts in the real vanilla stuff, which is like what's kind of fading out, because more and more of the population that we serve needs more help. So I also don't think in my lifetime of mortgages, we will see originators replaced by computers. I know that's always the talk of, like AI is going to take over the world and we won't need loan officers because you can just do it all on the computer. And I'm like, well, when 60% of the population doesn't qualify for an automated mortgage because they need overrides and thoughts on it.
Yeah.
I don't think we're going to get there, because you can't create a system that can solve for every single variable.
Well, yeah, you said it's not a one size fits all. It's absolutely the truth. Does AI factor in at all in any part of the process these days?
We use it for a lot like in copywriting and a lot of things like that up front. You see it a lot in like how to like interpret and push out guidelines and use AI on things like that, which saves time.
Yeah.
You can use like the industry uses doc recognition, and there's software like that is arguably made an impact on creating some efficiencies in the process. But I think our use of Chat GPT really is heavily driven on the marketing and the business development side of it, and not so much on the put the actual loan together side of it.
That makes sense. Yeah. I mean, yeah, if anyone's listening to this, like I've talked about that. I was in the mortgage business, and like when you're putting files together, I never did underwriting or anything, but even just like processing files and getting it ready to go to the new American fundings of the world, you're like, hopefully I can write a letter of explanation that's going to make all this make sense, because this is a
Yeah.
little muddy. This is a little gray. And
Yeah.
then, thankfully, like, the underwriter gods shine down on you and you get someone that's willing to, like, hear the story, and they're like, yeah, we can make that make sense for our
For
investors. I'm
sure.
like, oh, phew, thank God.
Yep. But it's like, without that, if we just relied on the computer, we'd just be denying loans left and right.
Yeah. Yeah. Interesting. Well, let's shift gears a little bit and talk about buyers. Like, what would you say to the prospective buyer that's hesitant to jump into the market this year?
I would say jump in because if you have even an inkling of interest, talk to a professional and really understand your situation. The closer we get to seeing rates get lower, it's just going to drive up demand and make things crazier. I don't see us back, it's not going to be with the 3.5% rates where there's 75 offers on every house, but there's just not enough time to make up for the inventory, and waiting under the hopes of better rates is kind of a flawed mindset, because rates from the beginning of time, and if we're from everything from cars to credit cards to whatever, rates fluctuate, and you can never time that market perfectly. And the more you try, I feel like the higher your risk is to fail. So your decision to buy or to get off that fence should really have nothing to do with rates in the market, and our interest rate's going to be better in a year, and should I wait? And it should have everything to do with, do I want to buy? Am I financially stable? Am I comfortable to buy? Do I need a larger home for my family? What are your needs is what should drive that decision, not the market, because that's what refinancing is for. I mean, even if we go way back, hardly anybody held their loan for 30 years and just paid it off. That is, the average person has their mortgage for less than 5 years. And it's because they're refinancing, not paying it off.
Yeah.
In most loans, like most people's tenure in their home includes 2 to 3 refinances over the time frame that they live in their home. So
I think that's something that people they just don't even factor that into the equation. But
no, and it's like, I want to wait. And it's like, if the payment is comfortable and the home is what you want, those should be the 2 biggest deciding factors, because rates will go up, rates will go down. When they go down, it makes sense. You can refinance and get some savings at that point. But waiting and hoping, because the other part of it is we're going to continue to see property values appreciate. So by waiting, you're also pretty much guaranteeing that you're going to pay more. So you're going to pay more for the house, and maybe if you were lucky, get a slightly lower interest rate. But that lower interest rate isn't going to offset the fact that you might have paid $25,000 more for the house than you would have this year.
Yeah. I love that you're saying exactly what I feel like I've been telling people all along. How can the mortgage industry better educate borrowers about their options and about the current market?
So do we have 16 hours?
You're like, this is my everyday thing.
And it is that basics of education. And I would love to see more professionals using the mediums that consumers go to right now, which is social media. And I hear so many people say, I don't want to be on social media. I don't love social media. And I'm like, I don't think any of us love to just hear ourselves talk and see pictures of ourselves, but we need to provide the education in the platform where the people are going towards it. So when we go back to the next wave of buyers, they're going to TikTok they don't go to Google something, they go to TikTok and put it in the search menu, and they're on Instagram. And I mean, even now I kind of chuckle because they say Facebook is for old people, Instagram's for the middle people, and then it's like TikTok is where everyone else is. And it's like, we have to, as an industry, it's like, whether you like that or not, if you want to make a difference and educate and get information out there, you have to do it to where you have to do it on the channels that people are looking. So I would say, as an industry, we need to use those better and have more people utilizing and sharing the correct information out there as well, like the educational information.
Well, yeah, we're going to talk about where people can find you at the end of the show, but Ellie does a great job of putting out educational. You put out fun stuff, and then you also put out tons of educational stuff, which that's what everybody wants.
Yeah, and it's easy little snippets. And I would say, and then the last kind of comment around that is getting back into like good old fashioned like homebuyer workshops is something that we see more and more of and are encouraging our teams to do it too, because it is, people need to be educated, and you can do coffee and bagels and an hour of education to at least give people some snippets of what they could be thinking about and working with as well. So there's just never enough education. I guess it's always the challenge.
That's I'm totally on board with that. Okay, so I saw some stats recently that were kind of blew my mind. Is that how many fewer mortgage professionals are in the business? Like that number keeps dwindling. What is it down to? Like, did I read the stat correctly? It's like 98,000 at the end of the year, but like 5 years ago it was over 300,000 mortgage professionals. Did I get those stats right?
Yeah, that is right in line with that. And I will say these are good things for the industry. So you see that staggeringly high number that we started with, and that was when loans were falling out of the sky and rates were as low as possible. Everyone was running to get into the business because it was, I hate to use the word easy, but it was perceived as easy. And I'm going to become a loan officer, and I just am going to have
make a ton of money, and it's going to be so easy. Yeah.
And I think these corrective cycles are always so good for the industry, because who remains are the professionals that are dedicated to keeping this as a career. It is the people that are committed to weathering the storms, that are going to do the work in the good times and the bad, and do things for, that have a passion about helping people and educating and working through those times. It's similar, and it's always mind-blowing too when you see that, like on the real estate side, like we have that huge shift on the mortgage side, and then you see also on the real estate side of how many agents aren't renewing licenses, or when you look and see how many agents sold one home or less.
Okay, the stat, I saw it this morning, 71% of agents in the United States sold 0 homes.
Yeah.
I'm like, what? I knew the number was bad, but I'm like, holy shit, that is really crazy.
But then I also go like, that goes to like why it's so important to know who you work with and work with a professional, because when you're looking at it, you're like, okay, well, of all of the licensed realtors in the United States, only 29% of them have actually sold a home in the last year. So, and this is like the biggest transaction of most people's lives. Mm-hmm. So I wouldn't want to, and no offense to people who have family in the business or really want to help there, whatever, but if my sister's brother-in-law is a real estate agent and hasn't sold a house in a year, I don't know that that's the person I want to represent me. I want somebody that knows how to negotiate, that knows how to actually represent me in my best interest, not just facilitate a transaction.
Yeah. I always say it's a contact sport. The more sales you have, the more nuanced you are, and the more you know your craft. As a mortgage professional or a real estate professional, you have to be doing the deals in order to know all the nuances and how to learn how to negotiate and learn players in the game. I'm like, there's so much more to it. I'm like, this could not be more of a cautionary tale right now, is that who you work with really matters.
Absolutely. Like, I mean, if I wish I had like a megaphone and I could scream it every single day, and so many aspects of life, but it's like, you get what you pay for, and, like value is not something that we should discount.
Absolutely. I feel like that's like the mic drop. Ryan, when you're editing this show, like that's the comment, or that's our highlight reel. So we talked a little bit about like inventory and buyer's market and seller's market. What do you think we're heading more towards a balanced market overall?
I do think we are heading towards a balanced market overall. You see a lot of like sensational headlines of sellers, it's a buyer's market and sellers don't have negotiating power anymore. And I'm like, hold your horses. That's not exactly where the market is.
Yeah.
Things are more imbalanced. It is not the right strategy isn't just going out and listing your house for more than it's worth and hoping they get multiple offers. I mean, that market is gone. But I'm like,
yeah,
that doesn't mean that it's not a balanced market or it's still not a good market for a seller. I think that there's a compelling case on all sides of that. And we just get back to the basics on what is realistic. And we kind of were living in the land of unicorns and rainbows when it came to real estate and mortgage for a couple of years when rates were so low that people forgot the reality of things. And it's never as extreme as maybe we think it's going to be. And I think we're headed for a balanced. I don't think it's going to shift and just become this crazy buyer's market or seller's market.
Yeah, I'm not seeing that, even though like the numbers tell us we're like leaning more towards the seller's market. The average house is not getting multiple offers. They're usually getting one really pretty solid offer, assuming that you price the house correctly. Yeah.
Well, and that's like,
and isn't that what we all want? You like all sellers, you want to sell your house. Like you don't need 10 offers. We just need one good one.
Right. And being logical and trusting those that you choose to represent you in setting a price, because one of the interesting things that was coming out, and it wasn't even like by NAR, was on like listing your house for a price that is out of the market. It's going to sit longer because people make the assumption that something's wrong with it when they start seeing price drops. So like taking that strategy of, well, my house is probably worth 500, but let's just throw it on at 550 and see if we can get any nibbles. Well, you didn't do yourself any favors and you do more damage than not. And saying, well, I can always drop the price later. Well, you can, and then you're going to have to drop it again and hope that you can get some action because people are like,
the consumer's too savvy nowadays. Like they're like, they can tell when it's not a bargain. You know, you go to the open house, there's nobody there. And you're like, well, yeah, this is probably. And then I always say it's like when you have a surgery and then you're like, well, I'm not going to take my pain pills because I'm not in pain. Well, you take the pain pills to keep the pain at bay. It's the same thing. Like if you price your house too high, then I feel like then you're chasing the market afterwards. And 9 times out of 10, you sell your house for less than you would have originally if you had just priced it correctly.
Yeah. And taken the emotional factor out of it, or the fact that your neighbor sold their house for something 2 years ago. And so you should really be able to get that or so much more.
Yeah, oh my gosh, that's always a really tricky conversation.
So back to work with the 29% of realtors that actually sell houses.
I love that. Are there any early signs out there that 2025 could be really like a big turning point?
I don't see it as a pivotal turning point. I feel like it is going to be it's going to be a good year. I see, there's like all signs point to that increased activity. Even NAR said up to 12%, and I'm talking like across the US, not just in one specific market, but up to 12% increase in home sales is what they're predicting from 2024. And if you've got the Mortgage Bankers Association thinking up to 15% in applications, that is a good, solid year. So I wouldn't call it like a big turning point in mortgage, but I think it is the market is now understanding of where it is, and that false hope of I'm going to hold out and get a rate in the 4s has waned. And the average person realizes that isn't happening, and that where we are today is a true reality. And we might see some incremental improvements in rates, but we're not going to see them drop 2 points at any given time. So I think it's going to just be a good and steady year. And that's good for the markets. The markets need steady years and nice paced growth. And we need to like measure that those are really wins, like, and say that was a really good year. Like every year doesn't have to be a banner. We shouldn't like need to measure it off the fact that we wrote the most loans we've ever written in our life because rates were at an unsustainably low rate. Because then it's like we're setting the bar to a place that always makes you feel like you're not good enough. I'm like, we're at a really good spot in the industry. We've got a lot of good product. You've got just a lot of options for people out there. And I just say we got to focus more on that than what was.
I love that. What's one prediction you're making for the industry this year that might surprise people?
Well, that might surprise people is probably that I was like the doom and gloom grim reaper of saying that I don't think rates are going to be in the fives by the end of the year. But I do think when I talk to people, the most surprising prediction is talking about that with rates being higher and staying higher, that we still expect to see a 10 to 15% increase in the industry in general. I mean, that is like, most people look at me like I have three heads when I say that, but I'm like, that's the reality of it. And I think that is also part of the testament that reality has sunk in for people, and they're ready to just make decisions that work for them and not hope for something that probably isn't going to happen.
I think that's really awesome.
So
I love that. Yeah. I feel like that's a great way to wrap up the show. Well, Ellie, where can people find you?
You can find me on Instagram at Ellie Cummings is my handle, and on LinkedIn at Ellie Cummings is my handle. And just follow me on Instagram. I don't even know my Facebook, but it'll push
tons of great info out on Insta.
It'll push there, but Instagram is really where we focus, getting the information out and the reach on that, and try to keep it short and sweet and educational with a little bit of fun.
I love that. Well, thanks for being here once again. Like I said, go back if you want more of this goodness and all of Ellie's insights. Head back to shows 80 or 127. But this show is all about 2025. And I appreciate you being here. It's so much fun I get a front row seat to your brilliance. It's awesome.
Yay. Well, thank you for having me, and cheers to a good 2025 ahead for everyone.
I love it. Well, until next time, bus bench babes, keep your face off a bus bench and keep being the badass boss babes that you are.
Okay, girls, are you feeling as inspired as we are? We're over here cheering you on because you just finished another episode of the Girl, Get Your Face Off a Bus Bench podcast.
If you want more, head over to girlgetyourfaceoffabusbench.com for show notes and more episodes. And don't forget to subscribe and leave us a 5-star review. They mean the world to us, and they're what keep us going.
Girl, thanks for being here.